Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures.
Welcome, everyone, to Macro Minutes. This edition is called The Aftermath, and today is the 4th of February 2025. This weekend and the start of the trading week were heavily impacted by US President Trump's decision to impose tariffs on Canada, Mexico, and China. He also mentioned that tariffs on the EU will definitely be imposed, although he hasn't given a timeline on that. Yes, the tariffs on Mexico and Canada have ultimately been postponed after some negotiations, but markets have reacted forcefully anyway. We've seen risky assets down, the dollar firmer. The bond market was firm as well, with US yield curves flattening while most other curves were steepening. And yes, there was some reversal, but some movements remained. In the meantime, we also had the FOMC pausing their rate cutting cycle. The Bank of Canada and the ECB delivered another 25 basis points rate cut, and we've got the Bank of England due later this week, when we and most market participants also expect a 25 basis point rate cut to come, which seems to fit the market pricing quite well. Now, we recorded an edition of Macro Minutes just last week, where we talked about the macro impacts of tariffs. This week, we want to specifically talk about central banks. In general, given the state of the economy, but also against the backdrop of tariffs that have been introduced. We have 4 speakers on the call today. We got Gwinn covering the US. We got Simon Deeley to speak about the Bank of Canada. I will talk about the ECB and the Bank of England. And we're also fortunate to have Thompson on the call, who will share his views on the RBA. So let's get started with the US. Blake, the Fed left rates unchanged, but that was last week. What do you think their thought process looks now, as far as the economy generally is concerned, but also factoring in the tariff discussion?
So yeah, Peter, as you said, the Fed did start their pause last week at January's FOMC meeting. They remain very, very data dependent at this point. I don't think they want to really take anything off the table. I think they're much more watchful. Powell said, the economy's strong. He seemed to have a lot of confidence that inflation was going to continue to come back to 2%. And I think the broad sense in the committee is that they really just don't need to rush into anything. I think they're just taking their time, taking a very gradual approach, careful approach. And I think that really extends over into the tariff and trade conversation as well. There's just a lot of uncertainty. I mean, I think we've seen over the events the last week or two, that these trade headlines are very hard to make kind of long-term predictions on. I think the Fed is in the same spot as most people in the market, which is that you just really have no idea how they're going to play out over the next 6 to 12 months. Is it going to be Canada, Mexico, and China? Is one of those going to be dropped? Are they going to expand to Europe? Are certain products going to be excluded? So just a lot of question marks on the actual path of tariffs. You also then have to take into account, escalations. Or 6 months time, we could be deep into multiple rounds of tariffs and counter tariffs with other countries. So just a lot of ways that this could play out. And I think it makes it very difficult for the Fed because on top of that, even if you knew exactly how the tariff story was going to play out, you had a perfect roadmap for the next 12 months, even still, you'd have some uncertainty around what that's actually going to do to the data. And there, I don't think the Fed really has a relevant playbook. We don't have a lot of modern history to look back on with tariffs. You have to go pretty far back to periods where, the Fed, their monetary policy framework and even the nature of the U.S. economy looked wildly different. So I just don't think they're really that applicable. One thing I've highlighted a few times to clients is, the U.S. is increasing energy independence. That really changes the way a lot of these tariffs might work than they did in the past. The other thing I would say too is just that businesses, and I would say consumers as well, there is this kind of post-COVID inflation mindset. I think the way businesses would think about passing through price increases to their customers has changed post-COVID. And I think also consumers' willingness, I wouldn't say willingness, I mean, people certainly aren't happy about it, but their kind of acceptance, I guess, is maybe a better word, of seeing price increases after the inflation of the last few years. So that mindset's very different. And I think now versus prior instances, much more likely to kind of spill over into inflation.
Let me chip in here from the Canadian side. We are very clear over here that the tariffs have a large impact on GDP down and on inflation, at least initially up. What does this do in the U.S.? Trump seems to acknowledge that there would be short-term pain. How does the Fed think about it?
Yeah, thanks, Simon. So I guess kind of following up on that last question, I kind of said the Fed is very uncertain. They remain very watchful. I think they're not going to be reactive, but they are going to be watching very closely in the data. If we kind of move further down this trade war path, it's very difficult. By the time this publishes, between when we recorded it and when it publishes, there may have been changes on that front. But the last we've heard is that we have had delays in both the implementation of both the Canada and Mexico tariffs. So that's what I'm kind of operating with right now. So one of the things that I think the Fed is going to be looking for first is just longevity of tariffs. If something goes into place for a couple of weeks and then we get an off ramp, that's not really going to be something the Fed cares about per se. I think where they might start to get concerned, even if we don't see those tariffs go into place or they last for a long time, is the uncertainty that it creates for businesses and consumers. And you saw Powell mention that in the January press conference. He did say that if this leads to prolonged and heightened uncertainty on the part of businesses, it could slow down CapEx, it could slow down investment, it could start to impact business and consumption decisions. So even if we don't see those tariffs get put in place, even if they don't last for a long time, even just the uncertainty could start to drag on growth. So that's, I think, one thing the Fed's going to be watching for. One thing I don't think they're watching, or I should say that I think they're probably going to look through, is direct price increases on tariffed goods. That is a one-time price level shift. I don't think the Fed sees their rate policy as a very good tool to address those price increases. So I think we can kind of write off one-time increases in prices or that initial pass-through to the goods that are getting hit by tariffs. What the Fed's really looking for is spillover price increases. If we start to see companies using those tariffs or using rising prices on those tariff goods, if they start using that as cover to put through price increases on other goods, that's where I think the Fed's really going to get more concerned. I actually tend to think that they're much more watchful and much more likely to react to implications on the growth and labor front than they are on the inflation and price front. I think they're going to be looking for demand destruction. If we see gas, food, other types of products, if we see those expenses going up for consumers, what does that do to their consumption of other goods? Are we just going to see this cannibalization of consumption as they have to spend more for gas every week or to fill the fridge up with groceries? So that's one thing that I think they're very sensitive to. I would also say global growth. In 2019, I think it was really that sharp deterioration in global growth that ended up getting the Fed to start delivering those insurance cuts. And as a reminder, we did see them cutting, responding to the slowing growth, not hiking, responding to the higher prices. So watching that global growth, I mean, if we get into a scenario where, maybe the U.S. has a better buffer, we're coming from a better starting place economically, we can weather these tariffs. But if other countries are seeing sharp slowdowns and their central banks have to start easing and rates are going down, we're not going to be immune to that. So I think that's another thing to watch for, is how much it is impacting that kind of global outlook. The last thing I would say is financial conditions. If we did see a big sharp move in risk assets, the first level would be kind of some type of verbal intervention. They start saying in the statement that they're watchful of these types of conditions, or start mentioning that in their speeches. But I think it's a very, very high bar to what it would actually take to get them to start moving rate policies, to start delivering insurance cuts on financial conditions alone. So I think sometimes the market overvalues a little bit this idea of the Fed put. The Fed would probably allow, pretty decent correction, in risk assets before they actually got involved. But it is something else that I think they are going to be watching for on top of those other things that I mentioned. So if I can, let's turn that back around to you, Simon. As I mentioned, I think from the Fed's perspective, these tariffs could have a much greater impact on the economies that they're being placed on versus the U.S. So we've got a very aggressive Bank of Canada call we have for quite a while now. I think you guys are at a 2% terminal rate. Our chief economist, Frances Donald, she suggested GDP impact on Canada could be pretty large. So has this kind of tariff back and forth on Canada over the last week, has that kind of strengthened, or has it weakened your conviction about where we come out on the Bank of Canada path?
As of now, Canada has a 30-day reprieve on U.S. tariffs following a deal announced on February 2nd covering border security measures and additional resources to combat fentanyl networks. Beyond the tariff analysis, the BoC meeting on January 29th was notable for having a relatively solid growth profile, 1.8% in each of 2025 and 26, and above our own of 1.3% for 2025. and an expected reduction in excess slack starting in the first half of this year. That growth profile reflects what the BoC characterizes as an economy gaining momentum and would see per capita growth increase given population growth is set to slow from reduced immigration targets. On the inflation front, recent core prints have been somewhat elevated, but not enough to worry the BoC, and they expect inflation to remain close to 2% over the coming 2 years. Absent tariffs, the BoC's economic outlook and communication suggest a pause in March would be possible, though our softer macro profile means pressure to cut should continue over 2025. The risk has grown that there will be a pause and/or the terminal rate will be somewhat above our 2% forecast. If tariffs ultimately come to pass, the BoC's reaction function would be highly dependent on the degree of retaliation. So Canada looks likely partial, with their responses over the weekend being 1/3 of imports from the US, and any fiscal response, unknown but would be expected from federal and provincial authorities. In most scenarios with tariffs, we would still expect the BoC to cut to around 2%.
Simon, a question that vexes me here in Europe a lot, and that seems quite relevant for you as well. We've seen a universal strengthening of the dollar lately, and of course that implies a weakening of the euro and sterling in my case, and CAD in your case. How relevant do you think these moves so far are for the Bank of Canada? And if they're not significant yet, at what point would they become relevant?
Relative to other central banks, the Bank of Canada is actually not as sensitive to exchange rate developments and tends to talk about them less frequently. There was an exception in last week's monetary policy report, with them devoting a special section on explaining recent CAD depreciation. Their analysis showed that while some of the CAD depreciation versus the dollar was due to interest rate differentials, most of it was due to rising exchange rate risk, likely tariff-related. Many other countries have seen similar moves, and it has driven broad-based dollar strength. Indeed, CAD has been relatively neutral more broadly, as reflected by being roughly flat in its trade-weighted index ex-USD. Moreover, the bank's own analysis suggests it takes a sizable move in the trade-weighted index, about 10%, to have a modest impact on core inflation, which would be a 0.25 percentage point. So we haven't gotten to those levels yet, even on dollar CAD, but certainly on the trade-weighted index, the levels are not approaching that 10% number. This underlines why the bank has felt comfortable diverging from the Fed and why we think the exchange rate will not be a main factor of driving monetary policy going forward. To be clear, below 150 for dollar CAD, and we think the BoC is reasonably comfortable, especially if moves are more fundamentally driven or part of a broader USD strength story. Peter, let me turn to Europe. So far, we have not seen any actual tariffs on the European economies, but the rhetoric has already amped up. How does the ECB think about it, and how has your thinking evolved since last Thursday's 25 basis point cut that was widely expected, as far as their next moves are concerned?
It's a very good question, Simon. So we haven't really seen any official analysis from the ECB, but we had a few speakers who have opined on it. Probably the most prominent were the Vice President de Guindos and also the French representative on the board, Villeroy. And both have essentially said the same thing. They have said that the near-term impact is probably inflationary, but that the medium-term impact is growth dampening and therefore probably disinflationary. Now, they haven't really said how they would react to the inflationary, the short-term inflationary impact, but the inference is that they might be inclined to look through it and keep cutting. Now, my problem that I have with this kind of view is that whilst this probably would have been the case 10 years ago, what we've learned in the recent inflation episode is that as unemployment is low and as wage growth is still quite ample, what we could see is if we have an inflationary impact, no matter where it comes from, if it does not lead to a broader increase in unemployment, it could well lead to an increase in wage demands in order to make up the lost gains in real term, and therefore perpetuate the inflationary problem. And that could ultimately be the thing that the ECB will be faced with. Now, therefore, my takeaway would be that the Governing Council would probably have at some point pause, which they probably will have to do anyway in their cutting, and assess the situation and whether or not there is a feed through as they expect, either in terms of inflation or in terms of growth, but that would require them to take a deep look at it and require time. So therefore, I do think ultimately they cannot just look through it as they probably would like to.
Let me also chip in here. Maybe not as dramatically as the RBA, but the BoE seems a bit behind the curve. What do you expect from the MPC this week? Can they remain as hawkish as they have been, given the economic backdrop seems to be weakening by the hour?
Yeah, thanks, Rob. I think that's a great question on the bank. Now, look, I mean, the bank has cut 50 basis points so far. Obviously, ECB has cut 125 specifically, and obviously others have been more aggressive as well. And I think the trade-off that the bank is continuously stressing is that on the one hand, we have relatively mediocre growth levels, but on the other hand, given the tightness of the economy and the intrinsic inflation pressures aren't going away. Now, one of the things that has happened since the start of the year as the bond market has rallied is that we have really increased the total amount of rate cuts that we're expecting for the Bank of England, whereas before the turn of the year, we were pricing in 50 and less. We're now pricing round about 90. And that's obviously significantly more. Now, one of the things that, however, has not happened is that we've been pricing a fairly speedy rate cut cycle. So we're still only pricing a good amount of probability for rate cuts to come in the so-called MPR meetings when they roll out new forecasts, such as this week's. But the interim meetings, we're pricing them only with a relatively small probability. And this is really where we think the possible surprise this week could come from. If they do open the door, let's say, for quicker rate cuts, back-to-back cuts, we think those inter-MPR meetings could really rise in implied probability for rate cuts, and therefore the entire cutting cycle could be coming forward. Now, that might increase the total amount of cuts that the market expects, but I don't think a great deal because the guidance on the total amount of cuts is probably going to stay unchanged. The question is really how quickly will they get there? And I think that's the question that will need to be answered this week. Rob, the tariff issue is probably less relevant for you at present, but we had soft inflation prints last week on your side. Does that finally allow the RBA to begin the easing cycle?
Well, the first order tariff impacts are less relevant, given the US isn't a large trading partner for us, and we're on a trade deficit there anyway, so we're not in Trump's immediate firing line. But second order impacts could still be quite material, given our dependency on trade with China. So the potential for downside growth impacts is still there. For now, though, it's indeed the inflation print that we're much more focused on for the RBA's upcoming meeting. And yes, we do think it'll allow the bank to finally begin their much-delayed easing cycle. Core-trimmed mean inflation came in well under consensus, and RBA estimates printing just 0.5% on the quarter. There was some subsidy impact, even on the core measure, but looking through this, we saw mostly all the right things, even on the non-tradable side, and services too, including on shelter costs, which are finally coming down. Even if we get a bit of a tick back up over the next few quarters, we think the RBA will be comfortably able to forecast core inflation settling back into the 2 to 3% target range in the first half of this year, so earlier than their November forecasts. A 25 basis point cut is all but fully priced already, so you could argue there's some decent risk-reward in positioning the other way for the February meeting. But we think the bank would love to cut and now has all the evidence it really needs to do so.
Hey, Rob, I know we're getting pretty close to time here. This is already running a bit long, but I did have one final question. I think this might be applicable for most central banks anyway. So the February RBA meeting might have a green light. Core inflation still above 3%. Unemployment barely 0.5% for the absolute lows. Can the RBA really afford to take the cash rate anywhere near neutral at this point?
The strength of the labour market does make it very difficult to justify more than 2 or 3 adjustment-style cuts for the RBA. Compared to dollar block peers, our relatively low peak cash rate and quite stimulatory fiscal policy, including a lot of non-market job creation, have kept employment outcomes remarkably strong. We swung back to 3 cuts from 2 after the inflation data, which would take us to a terminal rate of 3.6%. This is actually pretty close to where we see neutral, but it's a high bar in our view to go any lower than this. It would take a much larger and likely externally driven shock to growth and or the labour market to cut below this point.
I think we'll wrap it up there today. That's all for this edition. Thank you everyone on the call, and thank you everyone for listening, and hope to tune in again next time.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.